talking about what I think was the most telling moment from the conference call with Alex Karp presenting Palantir's financials and actually diving into when Palantir will become profitable, and that is directly tied to the stock-based compensation as he mentioned it. So I'm going to play a couple clips from him and then actually explain what he's talking about. So here's the first clip that you need to see.
There's stock-based comp and there's dilution. The dilution thing, that's a red herring. We're not issuing a lot of new shares. I think it's like in the $9 million range. And so it would be a little coy of me to say that's like no issue, move on. The thing to understand about Palantir, and then I want to just hit this, is like it's actually not the result of the DPO. It's the result of the fact that we were completely focused on building product. We had no earthly idea we were going to DPO till like right before we did it. And so most companies are, I mean, quite frankly, built so that when analysts look at it, the primary customer of most software companies is not the client, it's the software analyst. So it's like we obviously, our primary client are our clients, which doesn't mean, now we're thinking about how do we expose the data in a way that, people on the outside like you and professional analysts and others can look at the data and get a better sense of what's tracking and what's not tracking. But the primary source of a lot of these questions really comes down to, look, we built the company to support the U.S. warfighter primarily, and then dual use it for the glory of humanity, particularly humanity in the West. That was our idea. And because our primary client was not what someone at a hedge fund would think, we didn't actually think of these things from inception. And so now there's a process of normalization. You're going to see that in going forward on these calls. It's like, how do you normalize? How do you provide data that people can look at? How do you provide data that people can understand, that they're used to seeing, while simultaneously staying true to what our mission is? It's like our primary clients are the people we're serving. We're in full line with them, and that's why we survive. Even with the nascent sales force, you can get things to double, which is insane. So then you get to stock-based comp, which is like, okay, so there's two parts of it. Of course, IRI people kind of don't want me to do any kind of forward-looking math, but if you're smart enough to invest in Palantir, you're smart enough to figure out there's essentially there's the how are we comping people, and there will be a normalization that will get us into a range where you would see in a software company within the next 18 months, latest 2 years. But there's essentially, and that's going to take a little time. It is going to happen.
It's really great to have Alex Karp out here explaining the nuances of the business. It's not something that Sean was able to do earlier, and perhaps not something that the Palantir IR and legal teams even want, but it is very helpful, very insightful, and frankly should be something that the management team is talking about. So I'm not sure why it took this long, but basically what I want to explain is where the stock-based compensation actually hits the statement of operations here, which is the income statement. So we have revenue up top, which is what actually Palantir is getting for when they're actually licensing their software. And then below that, we have the cost of revenue. So that's actually how much it costs them to make it and to deliver it. So you see that little one right there, that if we scroll down, that actually includes stock-based compensation. These numbers are all in thousands. So for 2021, this was Q4, of the $433 million in revenue, they actually had a cost associated with that revenue of $88 million. So that's where the stock-based compensation is coming into play, which hits the gross profit number and then everything else below it. What Alex Karp is about to say in the clip I'm about to play for you, moving past the balance sheet with $2.3 billion in current assets of cash, we will actually see, if we get down here to the statement of cash flows, what happens with the statement of cash flows is under the operating activities section, you start with the net loss from the income statement, but you see down here stock-based compensation. Since this is a non-cash expense, you add it back in. You add it to the net loss because it's a non-cash expense. And you do all these other non-cash expenses for the operating section of the statement of cash flows, and you end up with a positive figure of $334 million. And then you can actually get to free cash flow, or cash flow positive for free cash flows for Palantir once you do the PP&E. So basically what's happening here is Palantir is already free cash flow positive. And why is that important? Well, that's because you need money after you're done with your property, plant, and equipment to be able to keep investing in the business, do other stuff with it. Obviously, you know what? I'll just play the clip. Here's him talking about how they need to go from free cash flow positive to a GAAP profit. Here it is.
Because it's also very much linked to another question, which is how do you actually run the company so it's profitable someday on a GAAP basis, not stripping out comp, and that is also within eyesight. And those are goals for Palantir, because same reason we have no debt, same reason we have $2.3 billion on our balance sheet. This is a company built for bad times. Bad times mean strong finances internally, and that means at some point you have to be GAAP profitable. You can't be GAAP profitable if you're diluting people, or your stock-based comp is totally is not in conformity with other companies. So you're seeing a normalization. This will change. It will change in the relatively near future. It'll be linked to other things that we believe are important for Palantir, like having a company that thrives in bad times. And bad times are very good for Palantir because we build products that are robust, that are built for danger, and then the finances internally are actually built for bad times. And bad times means you have free cash flow. The free cash flow turns into GAAP profit. That means the stock-based comp has to be one that's aligned with our investors. Also, because that's basically, it's part of a little bit longer philosophical narrative, but like if software is the only moat, then value and growth shares have to be evaluated in terms of their value. Value only exists if you can actually get a tech moat, call it, maybe it's something besides, and growth only exists if you build a company that is where the technology is strong enough, the business fundamentals are strong enough that the free cash flow actually turns into GAAP profitability, and that's linked to stock-based comp. So this is a priority both because you care, but also, quite frankly, because it is the health of our company, which we care a lot about.
Okay, so that was Alex Karp explaining why they need to go from their free cash flow positive number, which isn't listed here on the I don't believe the statement of cash flows, but they're free cash flow positive. And that's because you're adding back in the stock-based compensation, essentially removing the effect of it. But what does that mean? Well, that means that without, the stock-based compensation, we're doing pretty well as a business, very well actually. So he's saying once Palantir is able to normalize the stock-based compensation and it's more in normal figures in line with the way that the industry works, and the cost of revenue is going to drop in proportion to the amount of revenue they're making as they scale. As they scale, that's the key part. This is why he's saying it'll take 18 months or 2 years, but he knows it's going to happen. It's going to normalize, which means Palantir is going to become profitable over time. So when they have less and less, stock-based compensation down here, actually, we'll keep it on the income statement because that's where you actually see the profitability. When that drops, they're going to bring more to the gross profit, and then their operating expenses here, which also includes stock-based compensation right there, with the ones right there, those will also drop in proportion to the top line that they're bringing in, such that they will be profitable on an operating basis, and they're not actually going to lose from operations, and then they'll be able to deal with any interest income. That's a positive thing. Interest expense, which I don't know why they really have that if they don't have any debt, and then other income or expense, and then there's other accounting stuff where you got to pay taxes obviously. But once they're able to drop the stock-based compensation in proportion to the total revenue, that's what Alex Karp means by normalize, because Palantir has been doing so much stock-based compensation. The question is why? Well, they weren't thinking about going public when they were originally doing this, when they were originally building the company. They were thinking about, you want to know what they were thinking about? Being able to deliver for the U.S. government for their Gotham product. That's what they were thinking about. And now they've had to, as he said in the conference call, I think this was very useful to understand the thought process. They've had to sort of think about normalizing. That means less stock-based compensation into the future. It doesn't mean no stock-based compensation. It means they're going to try and get in line with the industry, which will please the analysts. That's going to happen over time, obviously. 2 years, that is a pretty long time. But they will normalize that. They will be growing as a business. And it seems like Palantir, in my opinion, might hit this inflection point where the stock-based compensation is low, the revenue is much higher, they're on their way to profitability, if not already there or in the black. It really seems like Palantir is going to surprise a lot of people in the future. Now, this is not a short-term thing. This is not a short-term thing. The stock-based compensation worry is really going to not be a worry much longer. If you think about it, 8 quarters from now, or even 7 or 6, probably 7, around there, based on Karp's pretty affirmative guidance there, that they will be more normalized by that point. I think Palantir could surprise a bit on the way to, as he says, profitability. Stock-based compensation is tied to their future profitability. So I think that's important because, it's the cost of revenue, it's the sales and marketing, research and development, and general and administrative. So SG&A and R&D on the operating side getting hit with the stock-based compensation, as well as they associate some of it with the cost of revenue. So they distribute it throughout the cost of revenue, but also the operating expenses, which really, weighs everything down, because you gotta demonstrate your expenses there. Even though it is a non-cash expense, they add it back. So the business is fine, as I showed you. The business is fine because if you look at the operating section of the statement of cash flows, we have a loss, but we add back the stock-based compensation because that's not actually a loss of our money as a company. That's just equity value. Okay, so that's where I'll leave it. Very exciting stuff, very interesting from Alex Karp to come out and say that. I thank him for the insight, and it looks like Palantir is on the path to profitability in a few years. Very exciting, but of course, we want to see the core business getting better and better over time. That is what matters. We don't need to see profitability immediately. We want them to keep investing in the business. At the end of the day, that's what stock-based compensation is. They're investing in the product. They're investing in the product here. Mostly sales and marketing, I guess, is also investing in the product there, but that's more so marketing. And general and administrative, of course, you have to deal with that as well to keep your business going. So that's where I'll leave it for now. Thank you for watching. Until next time.